So the outlook for community banks and credit unions is one of increasing challenges because we've got smaller financial institutions that have fewer assets over which to spread these compliance costs that we're talking about here. And looking at the numbers, you know, they seek to achieve this economy of scale as a consequence through mergers, which is not exactly what we want to encourage here. From 2013 to 2014, the number of community banks fell by 273 banks. Now, that's a 4.33% decrease in just 1 year. And similarly, we heard testimony that since mid-2010, 1,200 federally insured credit unions have left the market, and that's not the calling card of a sector that's doing better than ever. So I'll go to Mr. Williams and I'll ask him, because we did hear previously from a community bank that saw its compliance cost double in the last few years. They had to hire a new full-time, they had to hire full-time employees. They testified, as I recall, $65,000 each. And a recent Minneapolis Fed study found that 1/3 of banks with assets under $50 million would become unprofitable with the addition of just 2 full-time employees. That study was done because of these compliance costs. So a question for Mr. Williams: are we experiencing this situation where increased personnel costs affect the very ability to extend credit?
Congressman Royce, yes, we are. Frankly, it's difficult to measure our total compliance cost. I have colleagues that have said they have done an in-depth study and their costs are 18% of their operating budget. We estimate 15 to 20% of our operating overhead is now focused on hard and soft cost for compliance cost, and this would be up from 10 to 15 years ago, a 5% number. So I would easily say fourfold.
Well, personally, I think much of the problem is that recent regulations are aimed at attempting to outlaw risk-taking rather than ensuring through examination and supervision that such business practices are backed by adequate capital and low leverage. And so because of the approach, in my view, because if instead the focus was capital on the part of the regulatory community here, banks would be hiring more loan officers than they are hiring lawyers on the compliance end. I think we've set this thing in a way in which it's very injurious to the extension of credit.